Why is auto insurance going up in California, and how can we help mitigate some of these costs as a individual looking for insurance?
I think, first of all, to look at why the costs are going up in California for insurance rates. And I think that the reason that they're going up is, again, based on statistics. And in certain zip codes, you've got different, whether it's national disasters or different things going on that are causing huge losses for insurance companies. And them as a business, it's scaring them. Either you have certain insurance companies that are totally leaving, or that you have them increasing their rates significantly to prepare for those losses. And part of raising their premiums is creating larger amounts in reserve to be able to pay for future claims or anticipated claims. To answer your question directly, is there anything that we can do to be able to help as an individual to help reduce your rates if you are in California or any other location that might be experiencing national disasters and seeing insurance rates go up? Sometimes we have to operate in the margins. There's a certain amount that we can't control, but there is a certain amount that we can control. And to go back to the basics, drive slow, drive safe, have vehicles, purchase vehicles that are less expensive as far as insurance goes. There's a lot of things you can, repair your credit, make sure your credit is in good shape, because again, whether you like it or not, most times that affects what's going on with that. So work in the margins, do the best you can over here outside of moving. Those are some of the things that you can do. Anybody else?
And I guess my follow-up question to something like that would be, given our last year, especially last year, we in South Carolina and North Carolina experienced natural disasters that not many people expected to happen in Asheville. So how does that affect insurance when you're thinking about homeowners insurance? And this is moving topics, but also I just felt like it flows really nicely.
So something that happens sometimes in certain areas, there are things called binding restrictions. So if a carrier basically evaluates an area and they're like, this specific accident or occurrence happens a lot, so we don't want to cover this because it wouldn't be profitable, or it would be really hard to just kind of cover a whole area where they're affected like that. So what happens is that sometimes carriers will not be able to insure in certain areas for certain things. I mean, I think Asheville is a really good example of that. A lot of people aren't able to get flooding insurance on their homes or their vehicles. I'm not super familiar if you can get flooding for a vehicle. I know there's comprehensive and collision, but I know with homes, there's a lot of homes that can't get insured there for that because of how high of a risk it is. So that's something that, you run into occasionally. It's not just that it's not expensive, it's that they literally will not insure for a certain issue. So that can be kind of challenging at times, especially when you're trying to protect, your home or your family. Yeah.
So what do we do in that situation when we find an insurance carrier that won't insure somebody?
Oh yeah, we automatically will we probably do a combination of things. Since we have so many carriers that can cover different things, I know a lot of our clients have some insurances with some carriers and some insurances with others. And so I think automatically we just kind of try to pivot to find another carrier that can cover that. We want to make sure that our customers are taken care of, and that's the perk here at A Plus Insurance, where we're able to do that. We have a big docket of carriers that we can rely on for all different types of coverage. So, and that's what makes us so special. We're all pretty well versed in what our carriers can and can't do, especially state by state. And we go off of.
Yeah, I was going to mention earlier, I actually had 2 home insurance quotes in Colorado, and they were trying to get new insurance, renew it, and they were unable to because of the wildfire risk. And they said, due to the zip code, we're unable to insure this house because we're worried about the wildfires that are going to come through. And going back to California, I think they also have that issue with, they just had that issue with that fire that ripped through and destroyed all these homes and properties. And that's something these companies are going to take into account of, are we able to cover all this in the event of a disaster?
It varies depending on specific areas and specific natural disasters. So again, to restate how insurance companies handle some of these national disasters and some of these things that are seemingly unexpected. Some things are less unexpected than others. For example, the situation, Ms. Z lives near Asheville, North Carolina, and one of one of the things that's happened within the past year is that we've had a hurricane that affected that specific area. Insurance companies were caught way off guard because insurance companies can look back 50, 60, 70 years, but certain circumstances, this was a hurricane that affected properties that were 400 miles inland. And just the way that it happened to come inland and the amount of water and surge that it brought with us, and it brought with it the wind and the water, it created massive damage. And I'll be perfectly honest, there is no insurance company out there that anticipated just that. Now, there are so insurance companies, hopefully, just based on the nature, have done things to protect themselves and their insureds. They have a certain amount held in reserves for things that they didn't anticipate. So good insurance companies, you won't see a dramatic increase in 6 months. But there's certain other insurance companies that were caught more off guard that will have a larger increase in rates because they were caught off guard.
Different understanding. So from my understanding, gap insurance covers the difference between your car's actual cash value and the amount you still owe, like on a loan or a lease if the vehicle is totaled. It's especially valuable if you have a new car with a loan, like a loan balance higher than its market value. So if like you owe a lot more than what the car is actually worth, sometimes gap insurance can help cover, like little instances like that.
All right, so this question is really relevant to what's happening in California.